Welcome, and get ready to dive into the thrilling world of investments, where numbers dance, money talks, and the unexpected always keeps us on our toes. What's the best ETF for generating income? One popular choice for income-focused investors is covered call ETFs. They offer a high dividend yield and provide some protection during declining markets. JEPI is such an example, and you can check our recent discussion of JEPI here. However, there are two drawbacks of covered call ETFs. First, their return potential is capped during bull markets due to the nature of covered calls. Additionally, these ETFs are not considered tax-efficient investments. The dividends they provide are classified as non-qualified dividends and are taxed as regular income. The real question here is whether investors can benefit from the high dividend yield of a covered call ETF while minimizing their tax obligations and potentially gaining further from upward market movements. What if a fund doesn't distribute all its income from covered calls to investors, but instead utilizes a portion of it for something else, something that makes it appreciate in value? Introducing the NEOS S&P 500 High Income ETF, ticker symbol SPYI. This ETF offers a solution to the major issues associated with covered call ETFs while still providing an impressive dividend yield of 11.75%. Sounds too good to be true? Let's take a look at how it works in today's video. Before we dive in, if you find this information helpful, please consider subscribing to my channel and hitting the thumbs up button for the YouTube algorithm. Thank you. Let's start with the fundamentals. SPYI was established in August 2022, making it extremely new to the market. Currently, it manages around $160 million in assets. The fund's primary objective is to achieve tax efficiency and generate high monthly income by actively investing in stocks and options based on the S&P 500 index. When we look at the breakdown of the fund's holdings, we see that its asset allocation is identical to that of the S&P 500 index. Currently, SPYI boasts an impressive dividend yield of 12%, rivaling other major covered call ETFs like JEPI. The fund also has an expense ratio of 0.68%. For reference, for every $10,000 invested, you would pay $68 in annual fees. Considering the active management the fund employs and the extremely high dividend yield of the fund returns, the expense ratio becomes relatively negligible. So far, SPYI sounds similar to JEPI. It relies on selling covered call options to generate dividends to distribute to investors, but looking at the ETF's fact sheet, we can find details that sets SPYI apart from the rest. Number 1. The fund seeks to distribute high monthly income generated from investing in the constituents of the S&P 500 index and implementing a data-driven call option strategy. Number 2. Actively managed by NEOS. The fund seeks to take advantage of tax loss harvesting opportunities in addition to utilizing SPX index options classified as Section 1256 contracts, which are subject to lower 60/40 tax rates. Number 3. The fund utilizes a call option strategy that may include both sold and purchased SPX index options, which may provide the opportunity for upside capture in rising equity markets. To illustrate this, let's look at this chart. The dots on the chart represent monthly returns of S&P 500 since January 2000. The red horizontal line across the chart is the 2% mark. If a covered call strategy sells out of the money calls on the S&P 500 index that are 2% above the current market price every month, that fund is capping its growth at 2% each month in exchange for premium income. From historical data, we can tell that they are 103 times S&P has exceeded a monthly return of 2% since the year 2000, which is roughly a quarter of the entire period. As an investor, it's crucial not to miss out on these significant market rallies. So, how does the SPYI fund address this issue? From its prospectus, SPYI addresses this problem by adding another out-of-the-money call, which is surprisingly simple yet effective. The ETF utilizes a portion of the income generated from selling calls to purchase out-of-the-money call options. The purchase call option is further out of the money than the call option that's sold, ensuring a net positive premium for the fund. This strategic change gives SPYI a significant edge over JEPI. According to the SPYI prospectus, the fund's option strategy typically consists of two components: covered call options on up to 100% of the value of its holdings, and the purchase of out-of-the-money call options on the S&P 500 using a portion of the premium received from the covered call options. This approach allows the fund to capture potential upside if the S&P 500 appreciates significantly in value. With this tweak, SPYI improves its return payoff from something like this to something like this. It all sounds amazingly conceptually. Does SPYI's actual performance live up to its potential in reality? Since the ETF is so new, there is no historical data to backtest the fund's historical performance. But since 2023, SPYI has been leading JEPI consistently by a large margin. We know S&P 500 has risen sharply in the first half of 2023, and pure covered calls like JEPI are underperforming the markets. Meanwhile, SPYI has delivered an impressive total return of 14.5% at the time of this video, easily beating JEPI's 6.2% return. Looking good? We're not yet done. Let's delve into another aspect. Let's talk about tax efficiency, an area where SPYI truly stands out. Unlike other covered call ETF like JEPI, which utilize equity-linked notes or ELNs for their option activity, SPYI takes advantage of the tax efficiencies provided by Section 1256 contracts under the Internal Revenue Code. Essentially, Section 1256 contracts allow the income distributed to SPYI shareholders to be taxed as both long-term and short-term capital gains, as opposed to just short-term capital gains with ELNs, like JEPI. Under Section 1256, the tax on gains or losses is treated as if 60% of the contracts were held as long-term investments and 40% as short-term investments. This is truly remarkable. Additionally, the SPYI prospectus mentions that the fund may take advantage of tax loss harvesting opportunities. This means they can use investment losses from specific equity and/or options positions to offset realized taxable gains. By employing these strategies, shareholders can expect a reduced tax burden on their gains. It's truly amazing how SPYI sets itself apart in terms of tax efficiency. As we discussed in a previous video, JEPI and its sibling JEPQ are undoubtedly exceptional products. However, SPYI surpasses these two by combining tax efficiency with a high dividend yield, while also offering investors better potential for upside participation in the market. With these advantages, SPYI really stands out from the crowd. The only shortcoming of SPYI at this moment is that the ETF is quite new, and we don't know how it would perform in a market downturn. Although SPYI's construction makes one think the ETF would perform similarly to covered call ETFs like JEPI in a market sell-off such as in 2022, we simply don't have the actual data to speak for itself. Nevertheless, by comparing JEPI and S&P 500 performance in 2022, we are cautiously optimistic that SPYI would also outperform the broad market in a slowdown. That's all for SPYI. Thank you all for watching, and I look forward to seeing you in my next video.